a fallacy in markets that inflation actually benefits stocks, and that's not true. Historically, in the 70s and 1910s, which I think are the best inflationary environments to look back, the real return for equity markets was negative. And even in nominal terms, was actually pretty flat. And so I think it's, the opportunity really is in tangible assets in my view. Most of our focus has been in miners, has been in energy companies, in agricultural companies, in uranium. You can set up a portfolio that has a lot of opportunities in natural resource space today, which is still at depressed levels relative to any other asset you look at. And so profitability is at all-time highs for a lot of companies today. And in my opinion, what is interesting about this is the valuation spectrum relative to overall equity markets. And so I think that's where you want to hide. I think there's a lot of opportunities, certainly no shortage of things to do with capital right now.
Okay.
We've been investing a lot in precious metals.
Yes.
There's a lot of exploration companies. I think we're going to see exploration age in order to really feed the world that needs a lot of natural resources, and we have been underinvested not only in the capex trends, but really in exploration budgets. And I think that's going to lead to larger companies buying into the high quality assets in exploration.
Okay.
I think there's a lot of opportunities in energy. Certainly,
right.
Production companies, the larger companies, are trading at very, very cheap multiples. No, companies that steel producers, Brazilian companies, I think look really cheap and interesting, given the fact that it's a commodity exporter. It should benefit well from this inflationary environment. I think there are shorts that are great opportunities too. You can find shorts in the technology space. We're short most of the FANG stocks. We have shorts as well in the Chinese yuan. We have shorts in the Hong Kong dollar. Those are all ways of hedging a very long inflationary book. So if you think about our portfolio, majority is very long inflation. And then we have some hedges, which is mostly in equity markets and I would say being long the dollar. So the way to think about this is being long commodities and short equities, which is a famous chart of the commodities to equity ratio being a 50-year low. Well, I think there's a possibility of decoupling of the two, which we've seen the market leadership change right now with energy being up, for instance, just looking at the equity markets in the US versus the rest of the market declining. I think there's a possibility of that, but I don't need to be right on that. I just think that the ratio is going to be higher. I think we're at the beginning of bear markets, and sure, we're going to see bear market rallies and relief rallies like kind of what we saw today. However, I do believe that the environment we're in, it's hard to justify valuations that we have today in equity markets, especially when you have cost of capital rising and the Federal Reserve being forced to tighten monetary conditions the way it is doing. And so I believe that we're going to see valuations being re-rated, especially for technology companies and perhaps the very mega cap companies that today are, supposedly for every dollar coming into the S&P 500, imagine how much is going to FANG stocks. What if we have an outflow of those dynamics? I think that's going to hurt the FANG stocks in a big way. So I think there's a lot of ways. Just to go back a little bit, in 2021, we saw most of the kind of high valuation profile, hyped, overvalued names, especially software companies have suffered, ARK investments and so forth. I think the next wave is going to be mega cap and also companies that are going to be hurt by the squeeze of margins. So that's where my focus is on that hedge part of the portfolio.
Why did you pick the peak of the tech bubble as your support level?
Oh, I don't think it's going to be a support level. I'm just putting into perspective of how historically we are very, very expensive. Just think about this. NASDAQ is down about 27% or so. Back in March, it declined somewhere close to 30%. The Fed panicked at that time. They had to print a ton of money. They had to expand their balance sheet. And we've seen all sorts of policy making in order to support equity markets and save the economy. Today, we're quite the opposite. We continue to hear more how much more they're going to be raising rates and remove liquidity from markets. It's a very different environment. Corporate bonds are already down as much as they were back in the March crash. VC are down 50%. So the list is long of the damage already in the markets.
Now, if you think that equities have more room to climb down, to drop, in other words, don't you think that would also pull down the mining stocks?
There's a possibility. I think we've been conditioned to fight the last war and think about what happened in 2008 and 2020, and even back in other times that we had a reckoning moment for equity markets. But I think it's important to go back to what happened in 1973, 74, when we saw actually the miners go up fivefold at a time when equity markets are declining. Again, I don't need to be right about this, I think the ratio thesis is, or the spread trade of being long commodities, natural resources, and short equity markets is the really compelling thesis here. But I do believe that there is a case to be made that things could actually decouple from each other.
Okay. I have a few more charts that I'd like to show the audience. You've got a treasury yield chart. Now, yields have been ticking up. That's without a question. Do you think yields will continue to tick up? I'm tying this back into gold because gold really doesn't like higher interest rates.
Yeah, I do think the yields could potentially go higher. And I think that it's important to go back to the 70s. And I'm not claiming we're going to see 10-year yields at the same levels we saw in the 70s. But 10-year yields in nominal terms are actually more correlated to gold than in real terms back in the 70s. So
interesting.
It's important to remember that. But I do think that there's too much or not too much attention on what's happening when it comes to the issuance of treasuries. We're seeing somewhere close to $800 billion of issuances of treasuries in the last 3 months. The Fed was the largest buyer of that. They were buying 50% of that. They're not buying anymore. They're talking about selling.
Right.
Banks were buying a large percentage of that too. They're buying about 20% of the issuance. Large corporations outside of the U.S., they used to be the largest buyers. Now, with the geopolitical tensions rising, I highly doubt we're going to see the same strong demand that we saw over the prior years. So there's a lot of similarities with the 40s when it comes to this, maybe a flexibility from the Federal Reserve to come in and either reverse their current trends when it comes to tightening policy or cap yields at some point. I think that's the second wave for gold and tangible assets when there's some sort of monetary easing in an inflationary environment. I'm very focused on that. Very long gold. It's a very large percentage of our portfolio, not only gold itself, but really the miners.
Yes.
I think there's a lot of inefficiencies in the mining space. Unfortunately, we've seen a sell-off recently that not unfortunately, if you're a long-term investor, what an incredible opportunity to accumulate assets in the space too. But it's been a tremendous I would say pullback here for gold and miners, and I think it's undeserved. But anyways, there's a lot of opportunities. We've been with a lot of geographic focus in different parts of the world. I would say the Golden Triangle is something that we have a very large exposure to. We've got Newfoundland, Nevada, some parts of South America, but I would emphasize it's a very big percentage of our portfolio right now.
Okay.
I don't have a view that way because I think there's different parts of emerging markets. So it's not easy to answer that question that way. I would not allocate in China. I would not allocate in India. I would allocate in Brazil, and I would allocate as well in some parts of the U.S. when it comes to natural resource companies. I think Canada has some great companies as well in the natural resource space. But yeah, I would favor some other parts of the world like Brazil.
Well,
I think that's the potential, part of the thesis is that sure, you can see some of the emerging markets get hurt that way. I think Brazil is in a different position when it comes to the historical correlation of commodity producers global commodity producers relative to the equity markets in Brazil.
Yes.
Brazil has a long history of fighting inflation and it has been way ahead of the curve than the Fed and other developed economies when it comes to dealing with inflationary problem. And so I believe when you looked at valuations today, in Brazil, it seems just opportunistic to just allocate part of your capital there. And I think, it's been a good investment so far, and we think will continue to be.